Let's start with a question. Is a ton of carbon from, say, a car factory the same as a ton of carbon from a farm? I mean, really. How do you even begin to compare water usage in agriculture with something like microplastic pollution from the fashion industry? It's a tough one, right? And it really gets to the core of a huge problem that businesses have been facing for a long time. You see, for years, trying to figure out which company is actually more sustainable has been, well, almost impossible. Investors, consumers, even the companies themselves have been stuck in this world of comparing apples and oranges. Why? Because there was no single global standard for how to report on sustainability. But that's all about to change. Today, we're going to break down the new global rulebook that's designed to fix this whole mess. It's called IFRS S1. And really, you can just think of it as the new universal language for sustainability reporting. We're going to walk through exactly how a company is supposed to navigate this brand new landscape.
All right, so if you're a company, where do you even start? The very first step on this journey is just figuring out which specific rules and guidelines you need to follow. And let me tell you, it's definitely not a one-size-fits-all kind of deal.
So the IFRS S1 framework gives us this really clear hierarchy of guidance. It's kind of like a pecking order for what to look at first. You start at the top with the main IFRS standards themselves. Then you dig into more specific industry guidance from groups like SASB and CDSB. After that, you look at other official pronouncements. And finally, you can even look at what your competitors in the same industry are doing. Let's make this real. An agricultural company that's worried about water use, they'd look at the specific SASB metrics for agriculture. An apparel company, they probably use the SASB standards for labor audits in their supply chain. And an automaker, well, they'd be focusing on fuel economy metrics. See, it's all about finding the right tool for your specific job.
Okay, but what happens when you run into a sustainability issue that's totally new or unique? Something where there isn't a specific page in the rulebook telling you exactly what to do.
This is a great question, and it's one a lot of companies are going to face, especially in really innovative industries. So if you're dealing with a brand new kind of risk, what's the plan? Well, the standard actually has an answer for that. The key concept here is a little thing called applying judgment. Now, this doesn't mean just taking a wild guess. It means you have to create a disclosure that meets two big criteria. First, it has to be relevant to an investor's decisions. And second, it has to faithfully and accurately represent what's actually going on. Here's a perfect example of how this works. Let's imagine an apparel company realizes that microplastic pollution from its clothing is a growing risk. There's no specific IFRS rule that says microplastics just yet. So this is where they apply judgment. They might decide to use the existing SASB metrics for chemical management to disclose that risk. It's a way to be structured and relevant, even without a perfect fit rule. Now, here's the catch. If a company has to apply its judgment like that, it also has to be completely transparent about how it did it. The report has to spell it all out, which standards they used, what other sources they looked at, and maybe even mention any industry practices that helped guide their decision. And this is what that transparency actually looks like. A company's report will literally include a clear, simple statement like this one. It's basically them showing their work, laying out the exact recipe they used. The goal? No more black boxes. Okay, so we figured out what to report. Now let's get into the real nitty-gritty, the logistics. Where does all this information actually go? And when does it have to come out? And this is a huge change. Sustainability reporting isn't some separate, glossy report that a company puts out whenever it feels like it anymore. No way. It has to be part of the main financial reports, fully baked into things like the management's discussion and analysis, sitting right there alongside all the core financial numbers. And the timing rules, they're just as strict. These sustainability disclosures have to be released at the exact same time as the regular financial statements. They also have to cover the exact same period. And here's the crucial part. For every single number you report, you also have to provide the data from the year before. That way, investors can actually see the trend. Are things getting better or worse? This is exactly why that comparative data is so powerful. You can see, just at a glance, if that agricultural company is improving its certified sourcing, or if that automaker's fleet is actually getting more fuel efficient. It takes a single lonely data point and turns it into a real story of progress or decline. All right, we're at the final stage of this whole journey. The data's been gathered, the standards have been applied. Now it's time for the last checks and, of course, that all-important official sign-off. Now, here's a really key detail. The work isn't over when the clock strikes midnight on December 31st.
Not at all. If something significant happens between the end of the year and when the report is officially published, let's say a huge new emissions regulation is announced, the company has to update its disclosures to reflect that new reality.
Just think about it this way. If a biotech company has a major drug recall in January, that is absolutely something an investor would want to know when they're reading that annual report, right? Leaving that out would be super misleading, so IFRS S1 says, nope, you have to disclose it. And finally, after all is said and done, the company has to make what's called an explicit and unreserved statement of compliance. This is it. This is the final stamp of approval. It's a formal declaration that says, yes, we have followed every single rule. Now, there are a couple of very, very narrow exceptions to this. A company can leave something out if, for instance, a law actually forbids them from sharing it, or if it's a super commercially sensitive trade secret, like the secret sauce for a new drug that's in development. But I have to stress, these exceptions are meant to be rare, and you definitely have to justify them. So here we are. For the very first time, we have a clear, global set of rules. The playing field is finally being leveled. And that leaves us with one really interesting question to think about. Now that there's a common language for sustainability, who are going to be the leaders and who's going to be left behind?